Ever wondered why moving averages are a cornerstone in data analysis, especially in stock trading? Well, let's dive into that. Moving averages, you see, are like the Swiss Army knives of data analysis. They're versatile, reliable, and incredibly useful, particularly when it comes to reducing random noise. Picture a bustling market filled with a cacophony of voices. It's chaotic, right? Now, imagine you could filter out the noise and only hear the meaningful conversations. That's what moving averages do. They sift through the chaos of data, smoothing it out and making it easier to understand. But that's not all. Moving averages also help us identify trends and patterns. They're like a compass, helping us navigate the vast ocean of data. By plotting the average of a set of points over time, we can see where we've been and, more importantly, where we might be heading. Now that we've touched on why moving averages are important, you might be wondering, what exactly is a moving average? So, what is a moving average? It's simpler than you might think. To put it plainly, a moving average is a statistical calculation that's used to analyze data points by creating a series of averages of different subsets of the full data set. It's like smoothing out the hills and valleys of your data to see a clearer path ahead. Let's use a simple example to make it clearer. Imagine you're tracking the daily temperature over 10 days. You might have a series of numbers that look something like this: 72, 74, 70, 73, 75, 71, 73, 74, 72, and 75 degrees. To calculate a 3-day moving average, you would take the average of the first 3 numbers, then move one step to the right and take the average of the next 3 numbers, and so on. So for our temperature example, the first 3-day moving average would be the average of 72, 74, and 70, which comes out to around 72. The next 3-day moving average would be the average of 74, 70, and 73, which is about 72.3. This would continue until you've calculated the average for every set of 3 days in your data. This process of moving and averaging continues throughout your data set, hence the term moving average. The moving part of the term comes from the fact that with each new data point, you're moving your focus one point to the right. What the moving average does is smoothen the data series and iron out the fluctuations so that the underlying trend becomes more visible. It's like looking at a mountain range from far away. You won't see the tiny bumps and dips, just the grand sweeping trend of the range itself. The number of data points you average in a moving average, which is 3 in our example, is entirely up to you. The more points you include, the smoother your data will appear, but it'll also be slower to respond to changes. So, a moving average essentially smoothens out fluctuations in data, making it easier to spot overall trends. But what are the key takeaways about moving averages? Moving averages are more than just a simple math concept. They hold significant implications in the world of data analysis. Imagine a landscape of data, hills and valleys, peaks and troughs. It can be chaotic, hard to decipher. That's where moving averages step in. They act like a smoothing iron, ironing out the wrinkles and giving us a clear, comprehensible picture. By averaging out the data over a specific period, they reduce the noise and clutter, making the underlying trends more visible. Think about it this way. If you're on a road trip, you might experience various terrains. But what you're interested in is the general direction you're heading. Are you going uphill or downhill? That's what moving averages tell you about your data. But the magic of moving averages doesn't stop there. Their application spans various fields, from economics to meteorology. But perhaps their most popular use is in stock trading. Why? Because they help traders make sense of market behavior. Let's dive a bit deeper into this. When stock traders look at a price chart, they see a zigzag of ups and downs. This volatility can be overwhelming, but apply a moving average and voila! It's like putting on a pair of glasses. The blurry becomes clear. The erratic price movements smooth out to reveal the underlying trend. Moreover, Moving averages can also serve as support or resistance levels. When the price dips but doesn't break through the moving average line, that's a support level. Conversely, when it rises but doesn't surpass the line, that's a resistance level. These levels can guide traders on when to buy or sell. But what's more fascinating is that moving averages can be used as a tool to predict future movements based on past data. By observing how the moving average line has behaved in the past, traders can make educated guesses about future price action. So there you have it. Moving averages, a simple yet powerful tool in data analysis. Remember, understanding the past and present through moving averages can help predict the future. Until next time, keep analyzing those trends.